Question 1. In a property insurance policy, the provision that allows the insurer to pursue a negligent third party to recover a claim payment made to the insured is known as A. Arbitration, B. Subrogation, C. Salvage, D. Appraisal. Answer: B. Subrogation. The right of subrogation allows the insurance company, after paying a claim, to step into the shoes of the insured and sue the party who was at fault for the loss. This prevents the insured from collecting from both their insurer and the responsible party, upholding the principle of indemnity. For example, if your neighbor's faulty wiring causes a fire that damages your house, your insurer pays for your repairs and then sues your neighbor, or their insurer, to get that money back. Just remember, subrogation follows the money to the at-fault party. Question 2. Which part of an insurance policy personalizes the contract by stating who and what are covered, the policy limits, and the policy term? A. Insuring agreement, B. Conditions, C. Exclusions, D. Declarations. Answer: D. Declarations. The declarations page contains all the specific details that are unique to that particular policy, effectively personalizing the standardized contract. It answers the who, what, where, when, and how much questions, including the named insured, property address, coverage amounts, and the effective and expiration dates of the policy. Think of the declarations as the cover sheet of your policy that provides a snapshot of your specific coverages. Always review this page first to confirm your policy details are correct. Question 3. Under a standard business owner's policy, BOP, loss of income is covered for up to how long after the direct physical loss? A. 30 days. B. 6 months. C. 12 consecutive months. D. 24 consecutive months. Answer: C. 12 consecutive months. A key feature of the BOP is business income coverage, which replaces lost profits and pays for continuing expenses after a covered peril shuts the business down. This coverage continues until the business is restored or for up to 12 consecutive months following the direct loss, whichever comes first. For instance, if a fire closes a small retail shop for 8 months, the BOP would cover the net income lost during that time. The 12-month limit provides a substantial, but not unlimited, period for a business to get back on its feet. Question 4. The valuation method that subtracts depreciation from the current cost to repair or replace damaged property is known as A. Replacement cost, B. Actual cash value, C. Market value, D. Stated value. Answer: B. Actual cash value. Actual cash value, ACV, pays for the value of damaged property by subtracting depreciation due to age and wear and tear from its current replacement cost. This method upholds the principle of indemnity by ensuring the insured is not put in a better financial position than they were just before the loss occurred. For example, if a 5-year-old sofa is destroyed by fire, the insurer would determine the cost of a new, similar sofa and then deduct 5 years of depreciation to calculate the ACV payment. Just think of ACV as what the item was actually worth, considering its age, at the moment of the loss. Question 5. The legal principle that prevents a person who has previously given up a right from reasserting it later is known as A. Estoppel, B. Adhesion, C. Warranty, D. Waiver. Answer: A. Estoppel. Estoppel is a legal doctrine that prevents, or stops, a party from going back on their word or action if another party has reasonably relied on it. It is often a consequence of waiver, which is the voluntary relinquishment of a known right. For example, if an insurer consistently accepts late premium payments without penalty, a waiver, they may be estopped from suddenly canceling the policy for a single late payment. A good way to think of it is that the insurer is stopped from enforcing a rule they previously ignored. Question 6. All of the following are primary coverages under the liability section of a personal auto policy except A. Bodily injury caused to a pedestrian. B. Property damage caused to another car. C. Defense costs incurred by the insurer. D. Damage to the insured's own vehicle. Answer: D. Damage to the insured's own vehicle. The liability section of a personal auto policy, PAP, covers the insured's legal responsibility for bodily injury or property damage caused to others. Damage to the insured's own vehicle is covered under the physical damage section of the policy, specifically by collision or other than collision coverage. Liability coverage also includes supplementary payments, such as defense costs, but it never pays for damage to the insured's property. The key is remembering liability always means your fault and pays for the other guy's damages. Question 7. Which of the following describes a morale hazard? A. A faulty electrical wire in a building's wall. B. An individual who intentionally sets a fire to collect insurance money. C. An insured driver's indifference to loss because they are insured, such as leaving keys in the car. D. An applicant lying about their prior claims history. Answer: C. An insured driver's indifference to loss because they are insured, such as leaving keys in the car. A morale hazard arises from an insured's attitude of carelessness or indifference to loss because they know insurance will cover it. This is different from a moral hazard, which involves intentional, fraudulent, or dishonest acts like arson. A morale hazard is about a subconscious change in behavior, the "why should I care, I'm insured" mindset, that increases the probability of a loss occurring. For example, not bothering to lock up a bicycle is a morale hazard, while intentionally faking its theft is a moral hazard. Question 8. In a liability policy, supplementary payments are: A. Paid in addition to the policy's limit of liability. B. Subject to the policy's aggregate limit. C. Paid only after the primary limits are exhausted. D. Subtracted from the limit of liability. Answer: A. Paid in addition to the policy's limit of liability. Supplementary payments cover costs associated with a claim, such as legal defense costs, bail bonds, up to a specified limit, and loss of earnings for the insured to attend a trial. These payments are crucial because they are made in addition to the policy's stated liability limits, meaning they do not reduce the amount of coverage available for the actual damages. For example, if you have a $100,000 liability limit and the insurer spends $20,000 on your legal defense, the full $100,000 is still available to pay the claimant. Think of supplementary payments as an extra, built-in benefit to help manage a claim. Question 9. Which of the following is considered a named peril? A. Flood. B. Vandalism. C. Wear and tear. D. War. Answer: B. Vandalism. A named peril policy covers only those causes of loss that are specifically listed, or named, in the policy. Common named perils include fire, lightning, windstorm, hail, and vandalism. In contrast, perils like flood and war are typically excluded from standard policies, and wear and tear is a maintenance issue, not a peril. If the cause of loss isn't on the list, there's no coverage. Question 10. The authority that is not expressly granted but that an agent is assumed to have to transact the business of insurance for the principal is called: A. Apparent authority. B. Express authority. C. Implied authority. D. Fiduciary authority. Answer: C. Implied authority. Implied authority is the authority an agent needs to perform the duties of their express authority, even if not explicitly stated in their contract. It is the reasonable and necessary authority to carry out their job. For instance, an agent's written contract, express authority, may grant the power to solicit insurance, but it won't list every single task, the authority to print business cards or set up client appointments is implied. The key is that these actions are considered normal and necessary to conduct business. Question 11. What is the primary purpose of the Fair Credit Reporting Act, FCRA? A. To set rates for insurance policies based on credit. B. To protect consumers by requiring that consumer reporting agencies adopt fair and confidential procedures. C. To allow insurers to access credit information without consumer consent. D. To prevent insurers from using credit information in underwriting. Answer: B. To protect consumers by requiring that consumer reporting agencies adopt fair and confidential procedures. The Fair Credit Reporting Act, FCRA, is a federal law designed to ensure the accuracy, fairness, and privacy of information in consumer credit files. It regulates how consumer reporting agencies collect and share data and gives consumers rights, such as the right to know what is in their file and to dispute inaccuracies. When an insurer uses a credit report for underwriting, it must notify the applicant and provide the name of the agency that supplied the report if coverage is denied. The FCRA isn't about setting rates, but about protecting the consumer's private information during the process. Question 12. The principle of indemnity is best described as A. Restoring the insured to their approximate financial position before the loss. B. Allowing the insured to profit from a loss. C. Transferring the risk of loss to the insurance company. D. Sharing the loss with the insurance company through a deductible. Answer: A. Restoring the insured to their approximate financial position before the loss. The principle of indemnity holds that insurance should not make an insured better off financially after a loss than they were before it. The goal is to restore or make whole the insured by paying for the actual amount of the loss, but not to allow for profit. This concept is the foundation of property and casualty insurance and is supported by mechanisms like actual cash value and subrogation. For example, if your 5-year-old car is totaled, indemnity means the insurer pays you for the value of a 5-year-old car, not the price of a brand new one. Question 13. Which of the following homeowners policy forms provides open peril coverage for both the dwelling and personal property? A. HO2. B. HO3. C. HO5. D. HO8. Answer: C. HO5. The HO5, comprehensive form, provides the broadest protection of all standard homeowners forms. It covers both the dwelling, coverage A, and personal property, coverage C, on an open perils basis, meaning it protects against all causes of loss except those specifically excluded in the policy. This is superior to the HO3, which provides open peril coverage for the dwelling but only named peril coverage for personal property. Think of the HO5 as the deluxe or all-risk option for homeowners seeking maximum protection. Question 14. A temporary written agreement that provides proof of insurance until a formal policy can be issued is called A. Certificate of insurance. B. Binder. C. Declarations page. D. Warranty. Answer: B. Binder. A binder is a temporary contract of insurance, issued by an agent or insurer, that provides evidence of coverage while the formal policy is being underwritten and prepared. It includes key information like the named insured, coverage effective date, and limits, serving as legally binding proof of insurance for a short period. For example, when you buy a car, the dealer may require immediate proof of insurance, which an agent can provide with a binder until the full policy documents arrive. Remember, a binder is a temporary placeholder for the actual policy. Question 15. The condition in a property policy that specifies the insured's duties and obligations after a loss, such as giving prompt notice of claim, is found in which section of the policy? A. Declarations. B. Insuring agreement. C. Conditions. D. Exclusions. Answer: C. Conditions. The conditions section of an insurance policy outlines the rules, duties, and obligations that both the insured and the insurer must follow for the policy to be enforceable. These include the insured's duties after a loss, e.g., prompt notice of claim, protecting property from further damage, cooperating with the investigation, as well as insurer obligations. If an insured fails to comply with these conditions, the insurer may have the right to deny the claim. Think of this section as the rules of the game that must be followed after a loss occurs. Question 16. The taking of property from a person by someone who has caused or threatened to cause that person bodily harm is defined as A. Theft. B. Burglary. C. Robbery. D. Mysterious disappearance. Answer: C. Robbery. The key element that defines robbery is the use of force, or the threat of force, against a person during the commission of the crime. Burglary involves unlawful entry into a premises with intent to commit a crime, while theft is a general term for any act of stealing. For example, a mugging on the street is a robbery, whereas someone breaking into an empty house to steal a TV is a burglary. The threat of harm is the critical clue that points directly to robbery. Question 17. Which of the following is not one of the four required elements for establishing negligence? A. Legal duty owed. B. Breach of legal duty. C. Intent to cause harm. D. Proximate cause resulting in damages. Answer: C. Intent to cause harm. Negligence is based on unintentional acts or carelessness, not a deliberate intent to cause harm. The four essential elements of a negligence claim are: a legal duty was owed to the plaintiff, that duty was breached by the defendant, the breach was the proximate cause of the injury, and the plaintiff suffered actual damages. An act committed with intent to cause harm falls under the category of an intentional tort, which is legally distinct from negligence. Remember, negligence is an accident, not a malicious act. Question 18. If an insurance policy is cancelled by the insurer, any unearned premium must be returned to the insured on A. Pro rata basis. B. Short rate basis. C. Flat cancellation basis. D. Non-refundable basis. Answer: A. Pro rata basis. When the insurer cancels a policy, it must refund the unearned premium on a pro rata basis, which means the insured receives a refund of the full proportion of the premium for the unexpired policy term. The insurer does not get to keep any extra amount to cover administrative costs. In contrast, if the insured cancels the policy, the refund is typically calculated on a short rate basis, where the insurer retains a small portion of the unearned premium as a penalty. The key distinction is who initiates the cancellation. Question 19. The Terrorism Risk Insurance Act, TRIA, requires insurers to A. Provide terrorism coverage on all commercial property policies. B. Offer terrorism coverage on their commercial policies, for which they can charge a premium. C. Exclude terrorism coverage from all policies. D. Provide terrorism coverage for free on all commercial policies. Answer: B. Offer terrorism coverage on their commercial policies, for which they can charge a premium. The Terrorism Risk Insurance Act, TRIA, does not force insurers to provide terrorism coverage for free, nor does it mandate its inclusion in every policy. Instead, it requires insurers writing commercial lines to offer coverage for certified acts of terrorism and allows them to charge a premium for it. The insured business can then choose to either accept and pay for the coverage or reject it in writing. TRIA acts as a federal backstop, sharing the risk of catastrophic terrorism losses with the insurance industry. Question 20. The cause of a loss, such as fire, lightning, or theft, is known as A. Hazard. B. Peril. C. Risk. D. Exposure. Answer: B. Peril. A peril is the direct cause of a loss. Insurance policies are designed to protect against financial losses resulting from specific perils, such as fire, windstorm, or collision. A hazard, on the other hand, is a condition that increases the chance of a peril occurring, like oily rags stored in a garage, a physical hazard. For example, fire is the peril that destroys a house, while the faulty wiring that started it is the hazard. Question 21. Which method of handling risk involves an individual choosing not to purchase insurance and to pay for any potential losses out of their own pocket? A. Avoidance. B. Transfer. C. Reduction. D. Retention. Answer: D. Retention. Risk retention is the practice of accepting a risk and its potential financial consequences, essentially self-insuring. A common example is choosing a high deductible on an auto policy. The insured is retaining the risk of paying for smaller damages up to the deductible amount. Deciding not to buy optional coverage, like collision on an old car, is another form of retention where the individual accepts full responsibility for any related losses. Question 22. Under a personal auto policy, which coverage would pay for the insured's injuries if they were struck by a driver who has insurance, but not enough to cover the full extent of the damages? A. Uninsured motorist coverage. B. Bodily injury liability coverage. C. Medical payments coverage. D. Underinsured motorist coverage. Answer: D. Underinsured motorist coverage. Underinsured motorist, UIM, coverage is designed to protect the insured when an at-fault driver has liability insurance, but the limits are insufficient to cover the insured's medical bills and other bodily injury damages. UIM coverage steps in to pay the difference between the at-fault driver's low liability limit and the insured's own UIM limit. This is distinct from uninsured motorist, UM, coverage, which applies when the at-fault driver has no insurance at all. Think of UIM as filling the gap left by a driver who is insured, but not enough. Question 23. An employer can be held legally responsible for the negligent acts of an employee acting within the scope of their employment under the doctrine of A. Absolute liability. B. Vicarious liability. C. Strict liability. D. Comparative negligence. Answer: B. Vicarious liability. Vicarious liability, also known as imputed liability, holds one person responsible for the actions of another. The most common example is an employer-employee relationship, where the employer can be held liable for the negligent acts of an employee committed during the course of their work. For instance, if a delivery driver causes an accident while on a delivery route, the company that employs the driver can be sued for damages. The core idea is that the employer is indirectly responsible because the employee was acting on their behalf. Question 24. A property is described as vacant if it is empty of both people and A. Utilities. B. Personal property or contents. C. Furnishings for more than 30 days. D. Security systems. Answer: B. Personal property or contents. In property insurance, the distinction between vacancy and unoccupancy is critical. A property is considered unoccupied when it is empty of people but still contains personal property or contents, such as a furnished house whose owners are on a 2-week vacation. A property is vacant when it is empty of both people and a substantial amount of contents, suggesting a more permanent absence. Many policies suspend or limit coverage for perils like vandalism after a property has been vacant for a specified period, typically 60 days. Question 25. The method for resolving a dispute between an insured and an insurer over the amount of a loss, where each party hires its own representative and a third is chosen to act as an umpire, is called A. Litigation. B. Subrogation. C. Arbitration. D. Appraisal. Answer: D. Appraisal. The appraisal clause in an insurance policy is used specifically to resolve disagreements about the value or amount of a loss, not whether the loss is covered. If the insured and insurer cannot agree on the cost of repairs, either party can demand an appraisal, where each side selects an appraiser, and those two appraisers select a neutral umpire to settle the difference. This process is used to determine the how much, whereas arbitration is a broader process used to settle disputes over coverage itself or liability.